My next guest has served both the Bank of England and the New York Fed, so who better to discuss the prospect of the Fed's next step? And he's braced for this, of course, and I know that you, John, have found this unappealing, but you had to throw in the towel.
Well, yes, and I think, by the way, those numbers of $1 trillion and $2 trillion are far larger than we are going to see when the Fed announces.
What do you think we're going to see?
I think about $500 billion has been signaled, spread out over 6 months. There's still a number of people on the Fed, 4 regional presidents, including Kansas City's Tom Honig, who's dissented all year,
yes,
against this and thinks it's a bad idea. And so they can't go to a more extreme kind of number on quantitative easing.
But if it's $500 billion and you average that out, maybe a little under $100 billion a month, then, I mean, is that really going to do anything?
No. But it's like this. The patient's been very, very sick. We are in a slow recovery, and a slow recovery was inevitable. We've seen the work. Ken Rogoff, you had him in Bloomberg a few months ago talking about his work on recoveries from financial crises, telling us that this time it really isn't different, and the recovery would be a slow recovery. And that's what we're getting with a slow recovery. The Fed we have 0 rates. We have a Fed balance sheet over $2 trillion. We have long-term rates around 2.5%.
Right.
And that's not giving us a very rapid recovery. So throwing more at it is still not going to add to the recovery, because that's not what's holding the economy back. But there are harmful side effects. It's like treating a patient where the medicine does no good, but there are harmful side effects.
But holding the economy back, you say it's not going to address what's holding it back. So
absolutely not.
So what is?
Well, part of it, inevitably, we're going to be held back just by balance sheet repair. But what's really holding the economy back is uncertainties about taxation, uncertainties about regulation, the healthcare mandates being put on small businesses. So you have a 2-tier economy. You have a big business economy that's recovering and doing quite well, and you have a small business economy that's still in recession. And we have a Congress that has abrogated its responsibilities and gone off to campaign for next week's midterm elections without dealing with the issue of a massive tax hike that starts on January 1 if they don't change the law.
So when you say that, then we are basically relying on the Fed to do a job that they are just not capable of doing then.
Well,
what you're describing is
true. It's not a job the Fed's not capable. The monetary policy tool has been maxed out to the extent it's useful for the economy. And now we've gone further. We're now running the kinds of policies more than a year into recovery that we ran in 2003 and 2004 as the economy was recovering, that led to the bubble in the credit markets and led to the bubble in housing. Now we're running into the same, it was alluded to by the previous commentator, running into that kind of bubble environment. But where's the bubble this time? It's in emerging markets. It's depressing the currency. It's pushing up gold and silver prices, which are very bad indicators for the future stability of prices in the U.S. It's pushed real interest rates negative, so there's no return adjusted for inflation, holding bonds out to 5 years. In fact, you're going to lose money. And
it has us in a liquidity trap.
Well, as I said, we're at 0 rates. If 0 rates isn't going to get the economy moving, real rates are negative. So we're not in the Japanese-style liquidity trap where rates are 0 and the price level was falling, so real rates are positive. Real rates are negative. In the tips market, real rates are negative beyond 5 years. And the Fed's raising inflation expectations.
Okay, so then outlining, and you're depressing me, John, but outlining all of this then. So if the Fed is only going to be able to do $500 billion, as you say, then what do they need to do to accompany that then? Is there something else that they could do?
The Fed needs to be patient. And again, coming back to another Bloomberg guest a few weeks ago, Alan Meltzer, a professor at Carnegie Mellon, Fed historian, says more quantitative easing. There's already $1 trillion of bank reserves excess in the system. Creating more would be, in his words, literally stupid. You cannot control the short term. The Fed has grown impatient. It has a mandate. And it's not the Fed's fault it has this mandate. Unemployment's at 9.6%. It has a mandate to bring it down. But the monetary tools are not suited in the current environment to bring down the unemployment rate. But they are suited to raise inflation. They are suited to debase the dollar. We're seeing the dollar debasement. We're seeing big commodity price increase. And we're seeing, and this could be the biggest problem of all, a lot of tensions in the global foreign exchange market. So people are talking about currency wars. And if there's one way that quantitative easing will work to do something, it's to cheapen the dollar. And devaluing the dollar, the world's reserve currency, is just going to promote those currency stresses.
And do you, John, share the fear that the dollar is going to be debased to the point where it's not going to be seen as a reliable reserve currency?
Well, I hope not. And, about 62, 63% of the world's foreign exchange reserves are held in dollars. So in some sense, it's difficult. Where can people go from here? Will they go into the euro with the problems that the euro has had? The long-term beneficiary is probably going to be the Chinese renminbi, but it has to be made convertible and it has to be made free, and that's not going to happen. So in the short run, people are trapped in dollars, but nevertheless, it's not good when the central bank tries to devalue that reserve currency. No, not at all. Okay, John, thank you so much. Really fascinating and certainly a lot for us to think about with the Fed and quantitative easing that we've been talking about. John Ryding, the chief economist of RDQ.